Welcome to Finance for the Rest of Us, a non-academic, real-world series of explanatory videos designed to demystify the complexities of the financial world. Designed and crafted by Frederick Bovard, aka my own business mentor. Today, we embark on a journey through the profit and loss statement, or income statement. A P&L statement is an accounting document detailing a company's financial performance over a specific period, typically a fiscal quarter or year. It meticulously outlines the process of transforming revenue into accounting net income, highlighting operational efficiency and profitability in accounting terms. This distinction is crucial as it differentiates the P&L statement from a cash flow statement, which tracks the actual inflows and outflows of cash, providing a distinct perspective on financial health. We're going to dissect it piece by piece, making it easy for anyone to grasp how companies monitor their financial well-being and their capacity to generate profits from their business. So, let's dive in and demystify the P&L statement together, and see just how it reflects the heartbeat of any business. First, we have the turnover. Also called the sales revenue, or gross income. This is the total amount of money earned from selling goods or services during the year, or any other specific period of time. In this case study, let's say the company's total sales is 1 million. Next is the cost of goods sold, also referred to as COGS. These are the direct costs of producing the products sold by the business. In a bakery, for example, the expenses directly associated with the production are the flour, the water, the electricity, and the baker's salary. The baker's salary is included in the cost of goods sold because their role is crucial in the production process, even though their compensation is not directly tied to the quantity of bread sold. Although some costs, like the baker's salary, aren't variable, out-of-convenience cost of goods sold is sometimes referred to as variable expenses. Let's assume the cost of goods sold totals $500,000. Subtracting the cost of goods sold from the turnover gives us the gross profit. The gross profit is a key performance indicator of how efficiently a company is producing and selling its products or services. It tells us how much money is left after covering the direct costs of production. The gross profit is our first major milestone. In this case, the gross profit is of $500,000, which represents 50% of the turnover. It's always insightful to express KPIs as a percentage of the turnover, particularly for easy benchmarking against industry averages or comparing different years. The next step involves subtracting operating expenses from gross profit. Unlike the cost of goods sold, which varies with the sales volume, the operating expenses comprise costs incurred regardless of sales. This is the reason they are often referred to as fixed expenses, or as SG&A, which stands for Selling, General, and Administrative Expenses. It includes costs like marketing, leasing of equipments, or office rent, the salaries of anyone not involved with the production of the goods or the services sold, and other day-to-day expenses needed to run the business. In our example, the operating expenses amount to $250,000. Subtracting the operating expenses from the gross profit gives us one of the most important KPI, the EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It stands as a measure of profitability that excludes the impacts of financing decisions, tax jurisdictions, and the local accounting practices. In essence, it serves as an indicator of a business's ability to generate operational profits without the influence of external or non-operational factors. EBITDA is a crucial KPI, primarily because the most prevalent method of company valuation relies on it. We'll delve deeper into this topic in another video dedicated to company valuation. In our current example, the EBITDA stands at $250,000, constituting 25% of the turnover. Again, always keep in mind the importance of EBITDA in business analysis. Depreciation and amortization represent the decrease in value of the company's assets. The decrease of value of assets refers to the reduction in the worth of assets over time. For example, a car loses value as it gets older and accumulates mileage. Or a computer becomes less valuable as newer models are released. In accounting, this decrease in value is recognized as depreciation for tangible assets, like machinery, and amortization for intangible assets, like patents or softwares. For now, let's deduct $50,000 as the total for depreciation and amortization. But beware, although they are accounted for in the P&L, depreciation and amortization are not cash expenses. Depreciation and amortization are applied when the asset's costs exceed a specified threshold. This limit, along with the depreciation or amortization period, is often guided by tax rules, though companies have some flexibility. The threshold might be $500 or $5,000, or anything in between or above. Assets above this threshold aren't treated as operational expenses but are depreciated or amortized accordingly. Then companies can choose a depreciation or amortization method among the straight-line method, where the cost of the asset is divided evenly over its useful life. The declining balance method, where a higher depreciation or amortization cost is recorded in the early years of the asset's life, decreasing over time. The units of production method, based on the asset's usage, activity, or units of goods produced. After considering depreciation and amortization, we arrive at EBIT, which stands for earnings before interest and taxes, also known as operating profit. This figure highlights the profitability from the company's core business operations, before the impact of financial structure and tax policies. It's another important KPI. In our case, the EBIT is of $200,000, which represents 20% of the turnover. The next step involves accounting for costs and revenues not related to the company's core business activities. These are excluded from turnover and operational expenses, as they are peripheral operations, meaning they don't pertain to the main activities of the company. This includes the financial costs. Financial costs primarily consist of interest payments on loans. Only the interest part counts as an expense in the P&L statement, not the principal repayment. Indeed, according to accounting standards, the principal, though a real cash expense, doesn't hit the P&L as an expense. Meanwhile, non-cash expenses, like depreciation and amortization, do make the list. It's one of those accounting idiosyncrasies that just need to be accepted. Okay, let's consider a total of $80,000 as this year's financial costs. Next are the financial revenues, which relate to interests earned from investments. Let's say the company made $10,000 as financial revenues. Now, let's talk about extraordinary operations. These are events, or transactions, that are not part of the company's usual business activities. Think of things like selling a piece of land, or settling a lawsuit. These operations can significantly affect the company's finances, but happen rarely. This is the reason why, just like financial costs and revenues, extraordinary operations are accounted for after EBIT, to ensure we understand their impact on the company's profitability, separate from its regular operations. Let's assume those extraordinary operations generated a $50,000 profit. By subtracting financial costs, adding financial revenues, and subtracting or adding extraordinary operations, as the case may be, we reach another KPI, the profit before tax. It's the earnings before the government takes its share through taxes. Here the profit before taxes amounts to $180,000. Next, we account for profit tax, also referred to as income taxes, the amount a company must pay to the government. This figure varies based on local tax regulations and is not optional, it's dictated by law. Assuming the profit tax rate is 20%, this would translate to a tax amount of $36,000. Finally, the last line of a P&L is the net profit, also known as the bottom line. This number tells us the overall financial health and success of the business. Needless to say, it's an important KPI. In our case, the net result is $144,000, translating into a healthy 14.4%. Now, a crucial word of caution. As we've seen, the P&L statement includes non-cash expenses like depreciation and amortization, but doesn't account for actual cash outflows, such as loan principal repayments. Therefore, the net result shown on the P&L is not indicative of the cash remaining in the company. It merely represents an accounting outcome, not a cash position. Indeed, for a clearer view of the company's cash flow, one must add back the depreciation and amortization amounts to the net income, and subtract the loan principal repayments. Assuming the loan principal repayment amounts to $100,000, then the cash flow position will be net result $144,000 plus depreciation and amortization $80,000 minus loan principal repayment $100,000 equals to a cash flow position of $124,000. However, it's important to remember that the cash flow position calculated from a P&L statement is only theoretical. To accurately determine a company's cash flow, you must refer to the cash flow statement, which specifically tracks the actual inflows and outflows of cash. For more details on understanding the cash flow statement and its significance, please refer to the related video. Last piece of information: given that the net result does not directly reflect a company's cash flow position, it's possible for a company to report a negative net result without facing bankruptcy. Bankruptcy typically arises from a lack of cash, not merely from a negative accounting result like a P&L statement might show. Indeed, a positive cash flow position can result from cash reserves or shareholders' investments or loans, for instance. These sources of cash won't appear in a P&L statement, emphasizing the distinction between a company's profitability and liquidity. P&L statement is a vital tool for businesses to monitor their financial performance. By understanding each component, from sales revenue to net profit, we get a comprehensive view of a company's financial year, its health, and its ability to generate profit over time. Keep in mind that the P&L, alongside the other financial statement documents, tell the company's story. Thank you for walking through the P&L statement with me. Stay tuned for further demystification of the financial world. And if you're looking for further help, you can follow me on X, Instagram, and subscribe to my YouTube channel, My Own Business Mentor, or direct message me at myownbusinessmentor@gmail.com. You should also consider checking out my book, Finance for the Rest of Us, a non-academic real-world guide to fundraising, available at Amazon. It's packed with more insights and tips to navigate the financial landscape, whether you're starting out or looking to expand your knowledge. Thank you once again for your interest. Till next time.